Good morning, traders. Are you guys ready to get back to it with none other than the #1 morning show, Pre-Market Prep, ready to go ahead and get after it? We got a great one for you. We'll talk about buying the dip. Is it time? Is it working? We'll talk all about that. We'll also touch Powell's comments yesterday and today remarks to the House. So stay tuned for that. We'll definitely talk about, is there a soft landing or not? Berkshire Hathaway buys some more Oxy? Find out, guys, exactly what's going on there. Tesla, Darden Restaurants, analysts are awakening from the slumber, coming out of the cave. We'll talk about some of those analyst ratings, FDX after the close, stress test for the bank, and of course, we'll touch a little bit of some ticker time. Welcome to it, Pre-Market Prep. I got Joel Khan and Dennis Dick in the back. Let's get to it, and welcome to Pre-Market Prep. Let's go. Hit the likes.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, traders. How we doing? Let's go ahead. Let's bring on Joel Elconin. I will let you guys know his camera's not working today, but he will have his charts up. Let me bring up Dennis and Joel. If you could do me a favor, share those charts for us.
I wish my camera wasn't working. I'm still fighting this bloody cold, so it is what it is. The show must go on. Sick or no sick, we're here for you guys. What's up, Mitch?
Hey, let's go ahead. Let's take a look at the overnight action. Looks like we got a little bit of a rally going here.
Sneaky rally, man. I'm telling you, we were down. We were down, and the 4 a.m. buyers came in with the vengeance. Pre-market low, 37.35. Absolutely nothing for you there. Pre-market high, 37.97. Nothing there. Yesterday's high, 38.05.50. I think this is a pretty important day to see if this is just another dead cat bounce or this market has some legs. Crude rebounded from that shellacking yesterday, up 33 cents at 106.52. Gold down 750 at 1830.70. Silver in the red by 34 cents, 2107. And in Bitcoin at 20,635. Do you have to think that we are just forming a major bottom here at 20K that's going to spring load us to who knows? But 20K is where we broke out from. So there's some bullish comments. I should get some Twitter love for that. And Ethereum futures, they're up $35.50 at 1106.50.
Bitcoin's just a NASDAQ stock, Joel. So the NASDAQ's not making new lows. Bitcoin's not making new lows. JC Peretz putting those charts on top of each other from the last 6 months. NASDAQ, Bitcoin, same, look the same. It's a NASDAQ stock is what Bitcoin is now. So as long as the market, NASDAQ's holding up strong, expect Bitcoin to keep holding on to the 20,000 level too.
Okay, sneaky rally here, Dennis. I mean, we were down, right? At 4 a.m., we were down in the red by like close to 30 handles. And then they just came in with a vengeance right here. I'm looking at this bracket here. I'd like to look at a bracket and say, was there any news? And this was after Xi said that, they're going to do whatever they can to bolster economic growth in China. But that was a big rally. That kickstarted us here. We're starting to leak a little bit, but kind of like I said, just a sneaky 4 to 4.15 rally.
The buy the dip mentality is back right now. The buy the dip mentality again. Yesterday morning, we felt like it was a buy the dip opportunity. Oh, it was. I mean, they never looked back. Those Powell comments, where we were in the pre-market, we never even traded there. We just started climbing. Powell started speaking, and then they started rallying the market. So the buy the dip mentality is back. It's still working, sell the rip too. Buy the dip, sell the rip, both are still working. But right now, buy the dip is back in favor. Meaning you get these dips, they quickly get snapped up. There's money managers that feel like, and they got a good argument that a lot of bad news has been priced in. I mean, you talk about a 33% fall in the NASDAQ. You talk about a 23% fall in the S&P. These are significant falls. Don't kid yourself. Some bad news is priced in. Is the bottom in? Nobody has the answer to that question. Is a bottom in? Well, it looks like there's a bottom in here. We've come off the lows. The gross tech stocks, which we talked about yesterday morning, are the ones that are still holding on, and they were leading the charge yesterday. The Kathy names leading the charge. Again, I've said this, I've not been a fan of Kathy for a long time, but right now, I said this yesterday on the show, I kind of like her stocks. So they're holding up, not making new lows. So I think if you're sitting all cash, I think the time to deploy is on pullbacks. We had one last night. We had one yesterday morning. This isn't a pullback here now. We're ripping 25, but we get a little pullback here. I think you got to start nibbling. I'm not saying you go all in, but I'm saying the time to be 100% cash, I think, is past us. I think you've got to start getting some equity exposure just in case, it doesn't get as ugly as some people fear.
And it's like, how long are we going to go on? Is it recession, no recession, recession, no recession? I mean, is it just going to go on for the next year and a half?
Yes, this is what the media does. Yes. They sensationalize everything. Yeah. They want to ask that question 100 times a day. They ask it to every single person that comes on CNBC. Are we going to a recession or not? Nobody knows. We don't know. Nobody knows. That's the answer. Nobody knows. But what we can do is read the charts, and we can say we are oversold. We're due for a technical bounce. We're getting a little bit of a technical bounce. Trade it.
I was talking with some buddies yesterday, and they're like, well, technically speaking, 2 quarters of negative GDP growth,
is a recession.
Is a recession.
Yeah, correct. Correct. Yeah. I mean, it's already technically, it depends on what you want to consider a recession. That's the truth. There's no 100% way of looking at what a recession is, but there's a plenty of kind of indicators that say that we're already there. So, I mean, it's depending on what you want to look at. But
I would disagree completely with that. I don't think we're already there. I think the market is pricing in that we're going there.
There you go.
But I don't think we're even close. Like, there's stuff going on. I don't even think we've seen much of a slowdown yet. I mean, inflation's still hopping here. So I don't think that we're there. But has the market priced it in? Well, that's a good, valid question, because you don't get a lot of 35% sell-offs in the S&P. So have we priced in all the bad news? We priced in a lot of bad news. It's hard to say that we've priced it all in. But these growthy tech names that have just been beat up, I mean, Square. And I've been talking about this one. $300 stock, $289, down to $60, giving back 4 years of gains. I mean, is Block going away? Is Dorsey wrong? Is this a zero? I don't think so. I think there's value here eventually. The nosebleed valuation has come in where it's not even crazy valuation anymore. It's still probably not cheap, but it's not crazy anymore. And could they grow into a valuation like at this price? Probably. If you're buying Square at $61, do you make money 10 years from now? I tend to think so. But am I getting it cheaper yet? I don't know. I'm not in. It's been an ugly chart. $140 to $60 in 2 months is an incredible sell-off, though.
Well, there's no recession at Darden restaurants.
Yeah, we can go to Darden here. I don't mind going into Darden. Let's go ahead. Let's get into our earnings of the day. Let's go into Darden's restaurant here. They did announce a $1 billion buyback, so that's at least a decent sign there. Darden's earnings here, Q4 EPS, $2.24, beating the $2.21 estimate. Sales were at $2.6 billion, beating the $2.54 billion estimate. And what do you guys think? Darden restaurants? Who even goes to Darden restaurants?
I love Olive Garden. I don't go anywhere anymore. I just don't go out. But I mean, when I used to go out to restaurants, I used to love going to a good Olive Garden. I think they got rid of the Red Lobster. Did they get rid of the Red Lobster, Joel, or was that
it's still
in there or not?
Let me see. I'll check it.
Because they were supposed to spin one of them off. I don't even remember, but I don't know. So, anyways, it used to always be Olive Garden, Red Lobster. I like both those restaurants. The biscuits on both those, are amazing. So I think they're solid restaurants, but does that mean it's a solid buy right now? I don't know if I want to be jumping into restaurants here. If we're going into recession again, this is probably not the place to be. But has it beat up enough? 160 to 115 is there value? There's a 3.64% dividend, a little bit of yield protection. I don't think you're getting killed if you buy it here, but again, I don't buy rips, so I'm not buying it up 5%.
Get your breadsticks. Get your breadsticks.
And just going to like Oracle, and I'm just going back, not related companies at all, right? You got the earnings pop, and look what they did to that thing. It's almost back down to fill the gap, right? And then, Kellogg's, we're splitting into 3 different companies. We got the pop, and you almost revisited the low of the move. Now, totally unrelated companies, unrelated, as far as what they do. So conventional wisdom would be saying, hey, sell the pop here, right? If we can't get through one, I keep an eye on not only the pre-market high, but I want to get it too faked out. 122.75 was this hurdle here. So I think if you take out the pre-market high, you got some room up to there. Let's see if it if it can get to 122.75. If not, man, it's got a long ways to go to the top of yesterday's range. And that's been the pattern to fade these pops, whether they're earnings or breaking up the company or whatnot. So
it's been a tough market to chase in.
I'm not chasing. Yeah.
I don't like chasing either.
If you're buying this thing, it gets a little bit thinner stock too. You better have a tight stop on that one.
I mean, look at Oracle, the great earnings, the stock pops to $72, and here you are a week later. We talked about it, giving it back just because this is the type of market that does that, back to 66. I mean, there's a stock for you. You want to look at value tech. You want to look at a company that actually reported a pretty good quarter. You want to look at a company that's given back 2/3 of its gains. You want to do some nibbling and buy the dip in Oracle. I wouldn't argue with you.
We'll see. On Oracle, I've been trying to stay away from anything software, but I can't blame you guys if you guys are trying to take a shot.
Well, is this moving any other restaurant stocks? I mean, what do we got? MCD.
I was going to read you the brands here if you guys want. So the brands are for Darden. And you were right, Dennis. Longhorn, not Longhorn. Red Lobster is out. But it's Olive Garden, Longhorn, Cheddar's, Yard House, the Capitol Grill, Season 52, Bahama Breeze, and Eddie V's Prime Seafood. So those are the restaurants under Darden right now.
I don't think it's going to move the restaurants all too much, Joel. I mean, everything's just kind of moving together. Remember the type of market we're into, and I'm going to keep, reiterating stuff that I say. When I say stuff that's working, I'm going to continue to say it because it's working. Right now, correlations are more one, meaning stuff is kind of all moving together. I mean, we see oil up, stocks up. Oil, we haven't seen that for a while. But that's the market that we're in, is that stocks are moving together right now. So if you're, just jumping in on a flyer and saying, I'm going to go buy a bunch of restaurant stocks, because I think they're all going to fly today, I think it's going to be more dependent on what the S&P does. S&P is dictating all the moves for all the stocks right now. Everything is moving together.
All right, let's go ahead. We can move forward from Darden. We can take a look before we get, you know what? It's 8:15. Why don't we just go straight into Marc? Marc, give me a thumbs up if you're ready. Hey, you know it, guys. Marc is ready like always. Let's go ahead. Let's get out of Darden. Let's go to our special guest of the day. Of course, you guys probably know Marc Chaikin, but like always, do me the favor and definitely give Marc Chaikin the follow. It's literally at Marc Chaikin, so definitely check him out, and let's bring him on here. This is Marc Chaikin, the founder of Chaikin Analytics. How we doing, Marc? Good morning.
Oh, Mitch, doing real well. Dennis, hi. Just got back from the beach, the Jersey Shore, and
nice.
There's nothing to give you a better perspective than some sea air. So
there you go. So give us that good perspective you got going from that sea air there, Marc. Talk to us.
This is like 1973-4. It's the first time in 50 years that we've had what looks like stagflation, which is suppressed economic growth and inflation. And most investors and traders have never seen anything like that. We had a 40-year bull market in bonds, pushed rates down to zero. That's my overview. So I still believe we're in a bear market. I like the fact that energy corrected the way it did. Very painful if you're long energy, as you know I am. But I think real opportunity. Warren Buffett just announced this morning he bought another 9.6 million shares of Oxy.
Yeah.
I'll follow Buffett on that trade any day. The energy crisis is not going away. So we've had a series of bear market rallies. We had two 10% rallies. We broke that 3,800 level, which was critical because that's where we all hoped this decline would stop. But we're now into true bear market territory. We've reached my first objective, which was 3,600 last week. And I think the view going forward depends on what you think earnings are going to do. So
that's good.
The S&P earned $193, and the market was willing to put a 24.6 multiple on that. Consensus estimates, in my view, are still too high. Consensus estimates for 2022 are a 10% gain in earnings in the S&P, and the same for 2023. On that basis, you could argue the market's perhaps fairly valued, but doesn't that seem optimistic to you in this inflationary economy with pinching costs, supply chain issues, labor costs going up? So depending on what your earnings estimate is, if it's flat, $1.93, and you get rate compression, PE compression, which you always do in an inflationary environment, you could be looking at 18 times $1.92, which puts you down around 3,300.
Yeah.
If you think earnings are going to be down this year, 2 or 3%, now you're looking at 190, and you could see a 15 multiple on 190, which puts you below 3,000. So the scenario, if you're looking to where the market may bottom out, really depends on what earnings do.
What about the scenario where, and I'll just play devil's advocate because I've been bearish for a long time, but what about the scenario where they do navigate a soft landing, meaning that come in and the Fed, gets inflation check, and then they start getting the rates back down because, believe me, they're not going to hold these rates up here forever. As soon as inflation starts getting in check, they'll start giving it back again. What about the scenario where a soft landing does happen, economy doesn't go into a recession, earnings stay, at least stable? Is there a bull scenario anywhere here, Marc?
There is, if you think that raising interest rates can make a difference in inflation, but the exogenous factors, the energy spike is totally independent of the Fed. They can't print oil. And so you're looking at energy and food prices where you might have a worldwide famine because the breadbasket of Europe was the Ukraine, and that grain's not going anywhere. So you have two variables that are really outside the Fed's control. And so the notion that the Fed can bring down the inflation rate just by raising interest rates is, I think, fallacious. So that blows that scenario, unfortunately. Would I love that to happen? Yes. The flip side of that is the Fed does not want to see the stock market go up. Remember, the whole time we had quantitative easing from 2008 through 2021, 13 years of it, we didn't have price inflation. We had asset inflation, stocks, bonds, IPOs, SPACs, crypto. Now, the last thing the Fed wants is to get back into asset inflation. So I think it's a very difficult scenario. Powell basically told you what the playing field looks like yesterday when, for the first time, he said it's going to be really tough to engineer a soft landing. And if there's one guy I want to listen to in terms of the economy, it's not Elon Musk, it's Jamie Dimon. And he laid out the script 3 weeks ago.
Yeah.
There's a financial hurricane coming. So it's not the end of the world, but I think people have to position portfolios accordingly. And trading is tough in this market because you're still in negative gamma, which I finally found a simple way to explain it to our listeners.
Sure.
When people are buying puts, whether they're pros or individuals, the market makers have to go short to hedge the puts that they're selling them. That's called negative gamma. And although a lot of gamma rolled off on the expiration on Friday, you're still in a negative gamma situation where the break point to positive gamma is around 4,100. So very tough to get the market to rally much more than 10% on any move. And then, as we saw on Wednesday, they can be over very quickly.
Yeah, it's definitely tough out there. I did see you mention kind of the food inflation out there. Is there anything in maybe farm products that you guys are seeing that could point towards the upside? Maybe TSN? What do you like out there, and maybe some defensive area?
Yeah, I mean, Sanderson Farms, TSN looks interesting. Obviously, Kellogg after the announcement, but our Power Gauge rating was bullish on Kellogg's before the announcement.
Okay.
You can pick and choose, but now you've got the dilemma: do I stay in cash or do I go into defensive stocks? I've never been a big fan of defensive stocks because that's sort of trying to thread the needle between where the ultimate bear market low is going to be and what your money's going to be worth at the bottom. Dividend paying stocks have been the salvation here for the last 9 months, 6 months, really. I'm not sure that's going to continue, but dividend paying stocks with some level of growth are obviously an interesting place to be. And I'm starting to see little pockets of stocks that are going up. CRISPR, the only Cathie Wood stock that has a bullish Power Gauge rating. However, they did an investor day, and they call it innovation day, and they spooked the street when they said they were going to shift from one drug to the second in line instead of pursuing that. But if CRISPR holds up here above its long-term trend line, that's the kind of stock you might start nibbling on. In fact, some of the stocks that have really gotten decimated, that have real business models and are either making money or on the verge of making money, could be interesting here. And you really have to hunt and peck to find them. But they're going to be buys, but not quite yet.
We're on the line with Marc Chaikin, founder of Chaikin Analytics. Joins the show every 2 weeks. Marc, just talking about the inflation and the commodity picture. Crude has come off the high, still elevated levels, of course, from pre-pandemic and pandemic. But I'm looking at wheat. I'm looking at some of these other commodities. I mean, wheat has had a substantial pullback. Soybeans have had a substantial pullback. Corn has had somewhat of a pullback. You don't think that those are going to be all those other commodities are going to be coming down, coming off their highs, is not going to put a little dent in the uptrend in inflation? Is just all about crude and gas prices, electricity prices?
No, I think you raise a good point. I think some trends look promising, but really tough to get inflation down. I'm not a big fan of Larry Summers, but he laid out a roadmap of increases that you would have to have over the next 5 years in interest rates to impact basically the consumer. You've got to impact the consumer and the manufacturers. And so there's this whole inventory story out there that they overstocked the shelves because they were afraid of supply chain constraints. Now they've got to cut prices. It's not a pretty picture. Yes, commodities are going down, copper going down, lumber going down, grains going down, but you can't wish yourself out of a bear market. Bear markets take time. We've gotten spoiled. Bear markets typically take 18 months on average. You could argue that the market peaked in February of 2021 when the Cathie Wood stocks peaked, but it's hard to argue with a new high in the S&P on January 2nd. So we're either 6 months into a bear market or more like 12 to 18 months in some sectors. These things just don't go away. when you unleash the genie in the inflation bottle, it's very hard to put it back in.
And I think that's the trouble here, is that, there's been a lot of economists, a lot of people saying, well, we went through interest rate, raises before and the market has been just fine. But we've never been through an interest rate hike period where we've had inflation rampant like it was in the 80s. So, I mean, it's just a different economic environment, and those comparisons that, yeah, we're going to bounce back here in 6 months and be at new highs at the end of the year. I mean, this, because we did it in 2018, we're just not in that environment that we were in 2018. No, it's a completely different animal here.
Totally agree. And that's the key. And traders may be getting the hang of it because retail traders are, cutting back on options trading. And although they're buying index funds, in theory, if you believe the numbers from Goldman and Merrill Lynch, they're not trading the way they were. So, I saw a headline this morning when I was browsing headlines, buy the dip is back. This is really stupid. This is catching the javelin, not buying the dip. You do not want to catch the javelin in the stock market.
Mark, what about the volume here? I mean, I've been looking. We did have a quad witch expiration, right? And a lot of times that signifies significant turns in the market. And we made the low. We made the low on the day of the quad witch. And
at what price level, Joel?
36.39 in the S&Ps.
Just wanted to be on record with that one. I got a lot of grief from someone on this show.
Well, yeah.
You're not saying 3,600.
Get him, Mark. Get him.
I guess I didn't get filled on my 3,600.
Never put your order in at a round number.
Oh yeah,
3601.
3601.
3601.
So
volume man, I wish I could nail everything within 40 handles. But anyways, back to the volume here.
40 handles is only 1%.
Okay.
If you can call the bottom or the top within 1%, you're pretty damn good. Here's the thing about volume. You actually hit on something important. Up through the June, the May bottom, I was concerned that you hadn't had high volume down days in the SPY. The last one was back in early May or late April. On this decline that we saw a week ago, we did get two high volume days, the 13th and the 14th. And that was encouraging to me. You broke through all the standard deviation bands, whether it's Bollinger or Keltner, and then you came down and you made the final low on reduced volume relative to the max. And now you're rallying. If you come down again and test the lows and you don't get a high volume day, that would be a classic W pattern. So that first condition that I've been looking for to even think about a bottom was high volume in the SPY. And you got it. And I measure volume as two standard deviations around a 20-day average. Actually, 1.6 standard deviations around a 20-day average volume. It's an indicator that's on TradeStation, I think, where I do my research. So there you go. The conditions are in place, but you've got a tough environment. We are in that sort of what would you call it? Sort of news vacuum period between now and second quarter earnings. I think the biggest risk to the market, to sum it up, is if analysts finally start lowering their estimates based on what you get in terms of guidance with second quarter earnings reports in mid-July, that might lead to a viable bottom, because bottoms tend not to happen when analysts' expectations are still elevated. And they're up until a week or two ago, they were still raising their earnings again, 10% estimate for 2022 in the S&P. Just hard for me to believe that happens. And what happens if some of the cash cows that we've been looking at for years, like Apple and Microsoft, start to see a slowdown in growth? And we've already seen that from Amazon, Microsoft, and so forth. So if you ask me to map out the rest of the year, I think that when second quarter earnings come out, guidance is going to be poor. Analysts are going to start lowering estimates. We may get a tradable bottom around 3,400 to 3,600. Bigger rally than 10%. I've looked back at every bear market since 1960 on a daily basis, and you get rallies of 13, 14, and 15% in bear markets. We're probably overdue for one of those after a spillover, and then the final bottom in September, October. And I can't tell you the level, but some of the big banks are talking 3,100 to 3,300, and it's not out of the question.
All right. Well, thank you, like always, Marc Chaikin, joining us, the founder of Chaikin Analytics. Like I said, guys, give him a follow on Twitter. Thank you for coming on, like always, Marc, and we'll have you back on.
Be well, guys.
See you, Marc.
Did you not like the jobless claims number? We started leaking before that. Got up near 3,800, and then we just started to leak, and it was actually ahead of the the initial jobless claims. So we have pulled back off the high, not quite mid-range on the session. Sure looks like we want to go and test that double close area at 37.65. Potential for an inside day here.
I think so, Joel.
Yeah.
Russell rebalance tomorrow too, don't forget. So you're lining up for a lot of volatility tomorrow. Could be the calm before the storm here. So I think you do line up for an inside day. That simply means being inside yesterday's range, which was 80 points wide, at least on the SPY, 8 points wide on the SPY. So I think you're right in the middle. So I think you do set up for an inside day here.
All right, just wanted to kind of show where we've been at for the jobless claims. I have this, this is from tradingeconomics.com, but just kind of like a bar graph. And you can see how we've been increasing here. That's why I wanted to kind of show a graphical representation here. One of the things that's kind of interesting is the last kind of three rating, the three numbers all at the 229 mark. It's almost like, how do they do this? How do they keep it at that one spot? But yeah. Consensus before this was 227. Another thing to notice is the consensus has been moving upwards, right? And so as we keep going further and further, they're expecting more and more unemployment. That was also reiterated by Powell in his speech on the FOMC meeting, that he expects to see that increase start showing. So I wanted to go ahead and touch those jobless claims. Let's go ahead. We can continue. Do you guys want to talk a little bit more about what do you guys think about unemployment? Do you guys think that we're going to see a spike here?
Nah, I want to talk stocks, man. I think I'm not an economist. I took 70 economics courses in school. I know you took some too, and Joel. Yeah. But you know what? I'm 25 years removed from university, so I talk a little bit of economics, but jumping in unemployment, who knows? Who cares? Let's talk stocks, because that is what really moves. If you think you can look at economic data and extract, where this next stock move is, you're in the wrong business, man. So one thing that we do care about is the CPI number, but that doesn't come out for another couple of weeks here. So continuing claims, who cares? That's what I say. CNBC wants to cover for 25 minutes. Let them cover it. Boring.
All right, let's go ahead. Let's talk a little bit about Berkshire. Let's go.
Yeah, let's do it.
Let's talk about that.
Yep. Good one.
Let's get into that, guys. So, of course, Berkshire Hathaway buying 9.6 mil more of Occidental shares. This actually brings Berkshire's own now 142.3 million of Oxy, worth about 8.8 billion. The purchases were made over the past week and cost about 529 million. So going to keep an eye on what's going on in the oil trade. It looks like Berkshire double downing here on Oxy.
Not double. Wow. They had
at this time
shares. They got like 60 million shares or something. So, they're adding 2% to their position. Yeah. But this gets headlines. Headlines move stocks.
100%.
Headlines move stocks. Buffett hasn't bought anything for a little bit. So you knew when you saw that filing last night from your Benzinga Pro, which was right in there, that Oxy was probably going to pop on it. And obviously is this morning, up 3.1%. I don't chase, but I never short. One thing I've learned the hard way is shorting Warren Buffett is always a recipe for disaster, because traders like to follow him. And just like Marc said, he would follow him. Traders, just trade even intraday. 930 money managers follow him too. So I've learned something. You fade Buffett too soon, you get run over. So I think the easy money was made last night. So people buy the filing, stock's up 3%. They're probably ringing the register, the traders into it. Is there room on Oxy? I mean, it's pulled back. He's giving a vote of confidence into, a sector that has been very beat up here in the last 3 weeks. So does this, put in a little short-term bottom in Oxy? Probably. So leaning on, would I buy pullbacks in Oxy? Maybe. Long-term, again, we're talking as traders here. Long-term, I'm not doing much right now. But as traders, I've been saying buy the dip is back in favor, started this week. I think it buy the dip in energy could be, potential here too. So I don't mind the Oxy Warren Buffett play. If it was to pull back a bit, I might potentially buy that dip.
Dennis, have you just put your thinking cap on for a second? Have you ever seen him in Berkshire so aggressive in one stock? I mean,
you do. But he does do that, Joel. He picks on stocks. So he's not like one that, all of a sudden I'm just buying everything. He goes value and he does pick on stocks, meaning, he does get up that 10% ownership in a lot of stocks. So, and he builds it over time. So he's an opinion. He doesn't change his opinion very often. He's been bullish stocks, and we know he's been buying it for a long time. So you get a 20% pullback in OXY, and he says, come to Daddy Buffett, come to Papa. And that's what he was doing. So, but I mean, he is aggressive here. Is he caught in a value trap? It's hard to say. I mean, if we get real demand destruction, OXY will get hit here too. But there's a good argument that we're still got an energy crisis on our hands here. Ukraine war is still going on. Here's a stock that was, just made a new all-time high, or at least a new 52-week high 15 sessions ago, and it gives you a 20% dip. I'm not going to argue with the man.
Yeah, well, he actually started getting down and dirty in this when I can't remember, was it Anadarko and Chevron? Remember, who were they going after? I can't remember that, but it was a while, because I think he started buying this thing maybe in late 19 maybe. So he rode that dip out all the way down to $10, but he's been extremely aggressive in this one. And buying the dip. Yeah, just looking at this on a really short-term basis here. You just hit your pre-market high of 57.88. So you want to see follow through on that. You're only 40 cents off that. And then if you're looking for another target after that, you can go up a little bit higher. I see the next daily high at 58.74. So if you're looking for some more upside targets in Oxy, there you go. Got to take out the pre-market high first, though.
Let's keep pounding through some of these tickers in the chat. If somebody wanted to talk covered calls, we can do a quick little 2-3 minutes. We got some time here. There's multiple questions, and I know I'm sure the same person, but just so again, I've had this rant before. So covered call strategy, meaning you buy the stock and write a call against it to enhance the yield, to bring yourself a yield if it wasn't a dividend paying security. Great strategy for when the market's going sideways. There's no strategy that is better for a sideways market, because you're bringing in premium, it rolls off the board, you re-roll the premium, you bring it in. Works well in a slow up environment, works pretty well in a slow down environment. When you start to get these fat tails where you start to go into statistics, when you start to get market, getting hit 30%, that's where covered call strategies suck. Because one, and it also sucks the other way when those markets blasting off, because you're giving up your upside, but you're taking on the downside. You're basically writing insurance to a certain extent. You're like the insurance company. But when it really gets ugly, those fat tails happen, insurance starts to pay. I could tell you the years, the covered calls work really well, like 2002 to 2007, 2007, 2008, 2009. If you were running a covered call portfolio, you got your ass kicked, because the financial crisis came, and we saw stocks, obviously some like Citigroup, fall 99%. We saw other stocks, fall, significantly as well. So it works well in a sideways market. It works well in, a slow trending up or slow trending down. It does not work well in a market that's straight up because you're giving up the upside, or a market that's straight down because you're taking on the risk. So that's, the skew. So you'll see for years, from 2010 to 2020, covered calls probably worked pretty well. Slow, steady climb in the market. The calls enhancing the yield. You're still picking up some on the stocks, maybe not getting called away on everything. But in a market environment like obviously what we saw in March of 2020, which came back, but some people really got rocked there, and it's not working well in 2022 either. So you just got to know the market environment you're in. There's certain markets that covered call strategy is going to work. In this type of market, it's not working so well because you're taking on a lot of risk. That's
good
it.
Explanation. Yeah. And Spinner mentioned one thing. You can use the premium from the call to buy downside puts. The only thing about that is if you get just a flat market, it doesn't do a lot for you. But
and remember put call parity. So, you know, at a certain point in time, you're just owning the stock or you're short the stock. I mean, you know, you can mimic anything with options. So, you know, you buy the call and sell the put. I mean, it's the same as the stock. So, I mean, you've got to, you know, one thing consider. I mean, hedging is like everybody wants to put on the perfect hedge. Everybody wants to time the market perfectly, but it's still, hedging is all about timing. And I mean, you know, people are saying, oh, I got to hedge my portfolio. We see that commercial on CNBC now talking about, you know, hedging your portfolio now. I mean, you hedge now after the market falls, NASDAQ falls 33%. Now you're putting on your hedge. Man, that timing couldn't be worse. You know, maybe we're falling another 33%, but I mean, there's a time and a place to hedge. And that's usually when, you know, you anticipate a sell-off, not hedging after a sell-off.
All right, let's get another ticker here. Pablo is just pounding the table on the trade desk here and trading up 42 cents in the pre-market. Not seeing, I mean, you see some pretty good support on a relative strength basis. You never came. This is like your growthy tech, right?
Yeah,
didn't make
Kathy,
it.
Kathy name. I don't know if it is a Kathy name, but it's like a Kathy name.
Yeah, I think you just got to be a little bit patient with this one. I like this support, you know, building here above the low, right? And I don't think you can get super excited on the upside. You know, give me a couple closes over 50, you know, a new handle. People will think, hey, I missed the move. I got to get in. Don't know when they have earnings. The stock split certainly didn't do anything for them. Like to see a green monthly candle. That would be another thing, a positive. But see the support there and then the resistance. What do you need to have it's probably going to have a hard time having a positive month, right? Because way things got pounded this month. But not seeing any like super great levels in trade desk, Pablo. But there you go.
2 days ago was a great sell opportunity. That was the old support becomes new resistance. Now you've pulled back. I would just say 43.26, the low of the recent move from 4 days ago. If you're buying it here, it has to hold that. If not, you're going to see 40. So that's why I think you're going to see 40. So 43.26 would be my bogey if I was buying the trade desk here. Meaning, again, traders, newer traders, first set up your trade. Don't think about how much money you're making. Think about how much money you're willing to lose. This is the recipe for success in this business. So if you're coming in here, buying a 45.80, like, where's my out? First question, where am I getting out? 43.26 would be the logical stop-up point. So give yourself a few cents, say under 43, I'm getting out of this thing. I think there could be a market rally in the store. TTD would participate. I think the trade I actually think it sets up not bad from that risk reward. You're risking yourself about $2.5, $3.
Yeah.
And, you know, about 5% and saying, you know, if it gets up, 50 is a natural sell point, but, you know, maybe you can break out, maybe you can get above that too. The stock is oversold. Is there better setups? I kind of think so.
Yeah, I think so.
But there's definitely a level to lean on, and that level is 43.26.
And also, isn't this just kind of painting this like with a wide brush? I mean, advertising, right? Isn't this company derived? Mitch, can you help me out? I mean, that
yeah, that's what I was trying to get to.
I mean, you know, look at Meta. They're, you know, like they're giving up on advertising. They're you know, now in the metaverse. But you know, if companies are not making, you know, the profits that they want, they're going to look to cut expenses, right? Exactly. Where are they going to cut their expenses? They're going to cut their expenses in advertising. So from a fundamental standpoint, I don't, you know, I'm not in love.
This is why Meta's struggling, Joel. Nail on head. I mean, you think about, like, if we go into a recession, if we start to get tighter, those advertising dollars start to come in significantly here. Ground zero is a stock like Meta. So you ask, you know, why does this, you know, trade, you know, like at such a cheap PE ratio, while the market is anticipating that it's going to get uglier and those advertising dollars could come in, which means the earnings could come in. So it's not a matter of completely that they're still trying to find their way, which they are. And I watched that interview with Kramer last night on Meta, and it was pretty good. I mean, Zuckerberg speaks very well. He sells you on it. Like, you think like, oh yeah, I could see it. You know, I can, you know, like when they're on there, you know, I get it. I get the appeal to it all. It's just, you know, is this, you know, your recession-proof stock? Absolutely not. This is like a stock that gets hammered in a recession. So this is why Meta, continues to make new lows, made a new 52-week low again yesterday.
And you know what really kickstarted like this whole thing with that was Apple, right? When they changed their their policies and stuff on sharing. Besides the earnings, Apple really stuck a fork in a lot of these. Whatever. What else do we have? Pins, or I can't even keep track of all of these. Apple really did that, and they haven't been able to recover.
Yeah, I think also keep in mind, right, the DOJ stepping in on Meta what's not to say that they don't step into other areas, especially in advertising. That's what it was all about, right? Advertising in the wrong ways. So who's not to say that they don't step into TTD's game and to all the other advertisers out there. So I would be concerned about headlines. That's my concern about a stock like this, is one headline could have you down a couple 10%. So it's just, to me, in my eyes, I think it's a little bit too high risk just because of what the kind of the environment is right now in the advertising game. I think in 2020, it would have been an awesome stock to definitely be a part of. In this environment, it's not something that I want to be a part of.
Go back to our rules, that we write with trading. Stocks making new 52-week low, you got to go. There's absolutely no reason to own a stock making a new 52-week low. Yeah. So, we're arguing on Trade Desk. We have a bottom to trade on. You don't have anything on that. You could say, oh, yesterday's low, we're above yesterday's low. But you need to start putting in, instead of being a hero, because he could have been a hero the whole way down here. And there is pain above here. Meaning there's so many bag holders in the stock, my kid and his RESP being one of them. It's hard for the stocks to come back. They bounce back a little bit and they're like, oh, give me my money back, give me my money back, give me my money back. Everybody that's bought this thing in the last 3 years is down in it. So this is your classic value trap. Is there value here in the long run? If you're buying Meta and you're putting away for 20 years, do you make money here? I wouldn't bet against Zuckerberg. I think you probably do. So it depends on your time frame. But there's no reason as a trader to be a hero and say today is the day that Meta bottoms, because everybody's been trying to do that for the last 2 years and it hasn't worked.
All right, let me give at least some comments here from Mark Zuckerberg yesterday on Mad Money. He said that we hope to basically get around 1 billion people in the metaverse doing hundreds of dollars of commerce, each buying digital goods, digital content, different things to express themselves. So whether that be clothing for an avatar or different digital goods for their virtual home or things to decorate their virtual conference rooms, utilities to be able to be more productive, and augmented reality across the metaverse overall. It seems like a little bit of a push there, but I'll throw it to you guys. What do you guys think?
Well, we already talked Meta, so I have no more comments on it. So
yep. Trying to put a low in, but once again, looks like it has a date with 150 here. Getting back to that April low. If you're sticking out here, you got it 150.83. Your April 2020 low. It's kind of hard to believe, but let's go a little bit more rapid fire here.
All right, let's
how about Baba?
Yeah, I see Baba may mention.
Dennis, I'll let you go first with the Bobster.
Again, I think, and you can see with China, they're starting to support their stocks to a certain extent, unless something, here's the wild card is, the whole Taiwan situation. We don't know the macro political environment over there, geopolitical environment over there. We don't know. It's always a wild card. But from a technical perspective, these stocks continue to get bought on dips. From a fundamental perspective, if you believe the numbers, Alibaba is cheap. You put those two together, I don't want to be short it. And you can see every time the market goes to show a little bit of life, some of these China stocks are leading the way. So, there's oversold markets. There's been certain sectors that have been absolutely killed. China and the emerging markets we've been talking about, this is 10-year underperformance. So this isn't the sector that's going to get hammered in the next down wave. Even in the most recent down wave, FXI held up very well. S&Ps, just look over the course of the last, month, down 10%. FXI, flat. So, it's showing you relative strength. So I do think on pullbacks, the technicals are there to say that you can own some of these China stocks. If you start to break down and make new lows, maybe you got to look at Alibaba, maybe below 97, you'd be out. FXI, if you're trading that here, it's obviously up this morning, 31.13, maybe your level there, but you take a shot here on China, I think you can as a trader. On pullbacks.
Yeah, excellent point here. On a relative strength basis, this thing bottomed in May. right around 28 bucks, and it's not flinching.
They had their bear market before us.
Yeah, they did. Man, I wish I could give you some. I'll just go short term on this, and you made your pre-market high right when the buy-in came in, probably off the Chi comments overnight. They're gonna do whatever they can. So that 110.40. So I'm gonna give you a zone here, and it's a pretty big zone. You got to get through 110.40. Things kind of open up to what 112.75. If you want to try and buy it on the cheap here, 107, you could see that. That was a pair of highs from Tuesday and Wednesday for Alibaba.
Yeah, I've been bullish on it since that DD push, and we don't break that DD push. That was on June 6th when we were at 99, and we just got back above that 100. Keeps holding that 100.
It's holding well.
Probably going to push. And so
this K-Web too, same kind of chart.
China's holding up. I mean, China's full of all those same names. You know, it's full of Baba, it's full of Baidu, it's full of Tencent, which obviously is traded as an ADR over here. All of these names, all these China names are holding up very well. So you got to like the relative strength.
And also mentioned in the chat, just we won't get into it, but also the Chinese EVs have been also performing well. So check those out. Let's keep going. If you guys got stocks, throw them up in the chat. We could definitely touch them.
Lots of ticker time. You know, look at that.
Let's do it. Let's do it. We haven't done this in a little while. Looks like someone brought up Snow, saying that it's jamming higher. So we could take a look at Snow, SNOW.
Interesting. I mean, you did take out the May lows, 112 down to 110, but then you kind of held it in the last 2 days. You don't go even back to a few days ago, a little double bottom, 1375, 1428. Starting to show some life, starting to come out. You're chasing it now. Like, I don't know what the headline here is today.
Yeah, what's the headline?
It's up another $7. So obviously it's a rating or there's something here today. I didn't see it. I missed it, but I'm sure it's out there.
Yeah, we got
so it's hard to chase it here now. But, you know, if you were to give this to 2 days ago, I'd be like, oh, it's, you know, you got a little low to lean on. I'd probably be selling into the strength here now just because it's like you're up 20 points in 2 days in this market. You don't look a gift horse in the mouse, right? Is that how you say it, Joel? Don't never look a gift horse in the mouth?
You know, look at this one.
JP Morgan upgraded?
It was a JP Morgan upgrade? Okay.
Yeah.
You like this one, and I like a chart like this because I just look at the upper right chart and it just has 140 written all over it. And, you know, there you made the low of the move. You came back up, you kissed 140, it came down, you just undertaked it, right, by a little bit. You're back on the way up. I tell you got some, you know, it's up 710, so I'm not chasing it today. But longer term, I don't know if it would take some earnings or whatnot, but it gets a strong 140 stranglehold here, holds, and not just trades it over intraday to like 140.40. Just show me a base it for me, getting over that level. So that's what I would look at that longer term. And you're probably until yesterday, you were probably, or until today's price action, you were probably right in the 50% retracement of all this mishmash here.
Somebody asked Airbnb. I like Airbnb here. Not long term again because, you know, valuation's still not attractive, but you got a little double bottom, 92, 93. The crappy thing is you got to kind of give it down to 92, so I got to give it $7 or $8 here. I would much rather have it at 95 than 99, but I kind of like it. I mean,
you don't feel the demand destruction's coming for travel?
I think it already did, Mitch. I mean, Airbnb was a $250 stock. So again, this is our $220 stock. It's 99. So I think a lot of this is priced in. I mean, we could talk, you know, and if you just want to talk the travel stocks.
Yeah,
I mean, they've been absolutely massacred.
They've been getting massacred. Yeah,
massacred. I mean, RCL is $36. I mean, RCL, just to put it in perspective, bring it back to Airbnb in a minute. You're getting back down to the pandemic lows when the cruise ships were never going to sail again. So, I mean, they have priced in a recession. They're pricing in that nobody's ever going on a cruise again. Airbnb's priced in a lot of bad news, too. The one thing that keeps me away from Airbnb is just valuation. I'd like to call a bottom in the cruise lines. I'd love to do that. They're way oversold. But I don't know. If we go into a recession and they got all that debt kicking around, they got to start doing more secondaries, more offerings, and then you're in a higher rate environment. I mean, oil, and obviously we've talked about this before, you know, with oil costs and fuel costs, and all of a sudden, you know, the demand maybe not as strong as we thought. It's a recipe for disaster, but I mean, a lot of bad news is priced in. RCL has been cut in half in 6 weeks. That's incredible.
Yeah, China, not quite back at those pandemic lows, but yeah, I mean, just think about for all the time those big ships were idle, right? I mean, for the longest time. Martin hopping in here with Boeing. Did have Boeing's not giving up here. Had a nice rally. I know they got some orders, they got some upgrades and stuff. I'm still gonna stick with that line that I had out there. Didn't quite get there the other day.
Good line.
Yeah, 142. It kind of snuck over there. Once again, it's what for me, build a base and show a strong bid over 140. Fundamentally, I just think big planes. I don't know. I just think that the smaller carriers
got to get over that 140. Joel, your line is absolutely perfect. Before you get bullish of this thing, you really need to start seeing it get over that 140. And I mean, we've been in this downtrend in Boeing here for years. You know, $446 back in 2019. It's $137. It's hard to just get in this environment and say, okay, now is the bottom for Boeing, because again, anybody who's been trying to call that bottom for the last 3 years has been wrong every single time.
Remember, we had that guy that called the top in Boeing. I'm not going to bring his name up because we got a lot of heat when we had him on. Remember that, Dennis? That's like 3-4 years ago when that thing was at 400, 450. That might even have been pre-Mitch. Mitch, you might have been in like junior high when we did that.
Joel's memory, Mitch.
Hopefully I was in pre. Hopefully I was. That just means I'm young,
everything,
baby.
Man.
I'm hoping I was in diapers, man. But
I bet you Spinner remembers that. That was a long time ago. But all right, let's get back on the ticker train here.
Sure.
All right, so the next one up I want to touch is FDX because they do have earnings after the close. It was mentioned in the chat there, so let's go to it. Let's check out FedEx here.
You got to think they're going to be okay. I mean, the company came out and obviously, raises the dividend, gets the vote of confidence, held up. I mean, do they do all that and then report a crappy earnings? I don't think so. I mean, that would be, pretty nuts that you'd go ahead, you'd raise the they raised the dividend. What else did they do in that big move up? I'm going back in the pro now.
Yeah, well,
what day was
they
that?
raised corporate executive pay.
Back to
yeah, this was a couple weeks ago because I did it. We were dead wrong on this one. We thought it would.
They raised the dividend. We thought it would give it back, but it hasn't. But they raised the dividend from 75 cents to $1.15.
Yeah,
I thought they did something else too.
Yeah, there was some board changes.
Yeah. Oh, did they add some people to the board?
Yeah,
something
like that. Yeah, they added some people to the board. That was the decision there.
I just don't think you're gonna jack the dividend like that and then report.
Report bad, right?
And maybe it could happen. I mean, I guess we're in the market environment that could happen. I don't think that's going to happen. Obviously, they report tonight, so I tend to think the earnings are going to be okay.
I might take the other side. I mean, I just think you had we talk about the pull forward with the pandemic when everyone was getting everything delivered all the time, and the other, it's not that environment anymore. People are going out and doing things. And also with those big old gas guzzling trucks they use,
exactly.
the fuel costs. So I don't know. I just sometimes you look at a chart and you have a good feel for it. For this one, I was wrong when I thought it was going to fade off that move, and I don't know if I'd ever get a chance to buy it, to fill that gap. But I wouldn't. I mean, this thing takes out 220. Where you go? Where's your out? Where you oh yeah, 215. That looks good. Doesn't look anything to me. So that's my look.
It's always a gamble when you hold into earnings.
Yeah.
But I think you've got people who are potentially short this stock saying, well, eventually they all come back down. I've been saying on the show for a long time, wrong on this one. So I think you have bag holder shorts in here, believe it or not. Not that you go look at short interest and it's going to be light, but you have probably short-term traders in the last 6-7 days that are sitting here saying, I hold this line enough, eventually it's coming back in. And you get hit those traders. And I don't think the earnings are going to be bad. So I'm going the opposite way. I think the earnings are going to be good. I think the stock's going to rally.
Yeah. All right. So there's
that's why we're in the market.
Well, last time, show me a bit above 240, and then I'll get bullish. Look what
it's going to be earnings that it's going to take us above 240, or it's going to take us below 220. What's the expected move?
I don't even know.
Let's go look. But we can always look that information up. It's the nice thing about options. So to do expected move, we'll do the quick lesson, and then we're going to have to go because it's 9:01.
Oh, it's 9:02. I didn't realize that.
You can
I gotta
leave if you
go,
want.
guys.
I'll do the
Man, you kept me
expected
going.
move here.
Bye.
Joel's leaving. He's gone. FedEx
Boom.
expected move for earnings. Hang on. So what we do is we go and grab, and my options platform's coming up, but it is super duper slow here right now. Trying to bring up the strikes. I don't know why. I didn't have it open. Okay, coming up. So we can just go grab the weeklies, which expire June 24th. You can grab the one that's closest to the money, the 230. We can grab and you add them up. So you go between the bid and the ask. So because 720 on the close, this is obviously the options aren't open right now, so you got to go with the closing print. It looks to me like about $15 expected move. Wow, that's a big expected move.
Big expected move there.
I would not be buying the straddle on this. I'd be more inclined to write the straddle on this. $15 seems like too much because I know it takes you up over 240. Maybe you do breakout. Maybe it's going to be a killer report. Maybe it's going to run to 260 or something, but I don't think so. I think its expected move is really high. I'm surprised it's $15. So anyways, we add 15, 245 to 215 is what you would think the after hours range on earnings. If it's good, 245 may start to struggle. If it's bad, 215 may find buyers. So there you go.
All right, I'll let you go ahead and get on out of here. Dennis, you have a good day. Feel a little better, my friend.
Trying, man. This cold's killing me.
Feel a little better. All right, let's go ahead. We're going to start wrapping up, getting you guys over to live trading action. Don't forget, guys, though, 10 a.m. today, testimony by Chairman Jerome Powell. He addressed the Senate on Wednesday. Now he'll give remarks to the House. Watch live there on the Financial Service House Gov. I tried to get them to put it up here on Benzinga. I'm not sure if they're getting it up. We'll see if AB or Rohan is able to get it up. Semi-annual monetary policy report to Congress. So don't miss that, guys. That's going to be interesting. That's at 10 a.m. Eastern. So you could see some swings at 10 a.m. We'll see if we get that or not. Like always, up next, you guys got live trading with Benzinga, Zunaid, Lord Ryan, and Money Mitch. So get on over there, guys. Come check out live trading. We've been killing it. We've been definitely destroying it. Yesterday, got a great trade on Moderna. If you guys didn't catch that, come on over and find out what that was all about. And we'll see if we get some other trades on out there. Hit the like button, and I'll see you guys next time right here on the #1 show, Pre-Market Prep. Get you started and ready for the markets.